John Bogle. Mr. John Clifton Bogle was born in Montclair, New Jersey, on May 8, 1929. He is the founder of Vanguard, the leader of the index fund investment category, with over $1 trillion in investment assets. John's family lost everything, including the family home and inheritance, during the 1929 stock market crash. His father was an extreme alcoholic, leading to his parents' divorce while still a young boy. Living with his mother, John showed great academic promise. He was admitted to Blair Academy, a prestigious private high school in New Jersey. Unable to afford the expensive tuition, John's uncle managed to secure a scholarship for John. After an academically impressive 4 years and graduating cum laude, John went on to attend Princeton University in 1947. Again, with the help of a scholarship, John was able to study economics. He wrote his college thesis, which he received an A+, on index funds and how to improve returns for investors on their investments. His thesis was titled "The Economic Role of the Investment Company." John Bogle's approach to investing went directly against the Wall Street norms of the time. His peers in the industry mocked his ideas by calling them Bogle's folly. Bogle's reaction to this criticism was to further defy the industry and its self-protecting standards. Bogle's ethical principles became the foundation for a transformational investment company called Vanguard. His company would make all investors part owners of the company. Vanguard was created to provide an alternative for investors, an investment company where investing benefits the broker and the investor equally. Traditionally, the broker class extracts profits not only from their clients' investments, but also from the exorbitant fees charged to those same investors. These fees are charged in both profitable times and in times of loss. Vanguard's philosophy identifies and course corrects this glaring ethical flaw with the traditional investment model. John Bogle believes that it is ethically and morally wrong for a broker to walk away with 2/3 of the profit, leaving only 1/3 of the profit for the investor, when it is the investor who must take all of the risk. The other important component of the Vanguard model is no-fee or low-fee structures. Throughout his career, John has written many books to educate consumers on how to take charge and manage their own investment strategies. One of the most widely read is The Little Book of Common Sense Investing, the only way to guarantee your fair share of stock market returns. He demystifies the stock market, index funds, and compounding returns. "40 years ago, John Bogle was a lone, outspoken, principled voice, defending the fiduciary responsibility of investment firms to their investors. He even lobbied Congress to pass a law ensuring investment firms acted responsibly toward those who risked their investment capital. Today, Mr. Bogle is known by many as St. Jack because he represents the individual, little guy investor's interests. Mr. Bogle, now retired, stands firmly upon the principles with which he created wealth opportunities for so many. He continues to advise investors not to try to beat the market, but to buy and hold, and to be disciplined in savings. This is a better way to secure one's financial future. Bogle's success is unparalleled, although his net worth is much less than many other business moguls of his time. This is another indicator of his true motivation to be an agent of change that helps consumers as a priority.
Hi, I'm Christine Benz from Morningstar.com. The index fund recently celebrated its 40th birthday. I sat down with Jack Bogle, Vanguard founder, to discuss that milestone. The index fund celebrated a big birthday, anniversary, whatever you want to call it, 40 years. Let's talk about that. This was your doing, and let's talk about whether the uptake of indexing was what you expected. Did you expect it to take off faster than it did?
I expected it to take off two things, one good, one positive, and one negative. The negative is I expected it to take off much faster than it did. It took 20 years until the mid 90s,
right, for
it to begin to gain real traction. And then it accelerated, and the growth from 1995 to 2016 has been astonishing, and it's sustained. And the cash flows are over 100% of the industries. Vanguard leads in that, and of course, so it's done a lot of good for a lot of people. People say, why doesn't everybody start an index fund? And I said the answer to that is very simple. All the darn money goes to the investors. This is a business.
The money's not in it for the...
Yeah, they're in it to earn a return on the capital, particularly the capital that owns the firm, all those conglomerates that own these firms. And the mutual fund division of that firm, or the mutual fund organization, it's a subsidiary, has to produce a return on the buyer's capital. And if you don't, the buyer will get somebody who will. I mean, capitalism is a hard business. But the capitalism in our business should be focused on the shareholder who puts up the money, puts up the capital, takes the risk, and ought to get all the reward, and he only gets about a third of it over time.